Hey everyone, welcome back to Corporate Decoder. Today, we are diving into One Liberty Properties' latest annual report, and trust me, there are definitely some interesting things to decode. It's like trying to predict the future of retail while also keeping an eye on the industrial real estate boom. What could go wrong or right? Let's find out. First off, One Liberty Properties, or OLP, is a real estate investment trust, a REIT. Basically, they own and manage a bunch of properties, mainly industrial ones and a few retail spots too. Think warehouses and distribution centers alongside the occasional shopping center. They make money by renting these properties out, and as a REIT, they have to give a big chunk of their profits back to shareholders as dividends. This report covers their performance up to the end of 2024, so let's see how they did. OLP boasts a portfolio of 102 properties spread across 31 states, totaling about 10.9 million square feet. That sounds like a lot, and for OLP it is. The vast majority of these properties are occupied, about 99%. That's a pretty solid occupancy rate, meaning most of their properties are bringing in money. Looking ahead, OLP is estimating about $72 million in what they call contractual rental income for 2025. It is important to pay close attention to these non-standard metrics, as they can overstate or understate true performance by not taking into account a variety of standard costs associated with the business. They have been active with acquisitions, with 3 new industrial properties in 2024 and even more in early 2025, expanding their portfolio into Alabama and Kansas, and planning another purchase in Iowa. They have also been selling off properties in order to maintain a strong cash position. OLP's main goal is to boost shareholder value. They plan to do this through strategic property acquisitions, smart management of their existing properties, and getting good deals on financing. They also are committed to maintaining access to capital in order to fund future growth. OLP has a particular focus on single-tenant industrial properties with long-term net leases. These leases, where the tenant covers most of the property expenses, provide a predictable income stream and make it easier to get financing. Who are their tenants? Well, a significant part of their income, about 72%, comes from industrial tenants, with retail making up most of the remainder. FedEx, Northern Tool, and NARDA Holdings are their big names, accounting for a notable chunk of their 2025 expected income. Losing one of these tenants or them not renewing their lease would really hurt. OLP does have leases expiring every year and faces the constant need to renew or replace them. The good news is that their portfolio is well diversified so that no single year has an overwhelming amount of renewals to handle. In 2024, OLP strategically sold off 11 properties. They sold these because they thought they had maxed out the value of the properties, worried about the tenants' long-term viability, or had other refinancing challenges. OLP operates in a competitive market up against some huge players like bigger REITs, private equity firms, and institutional funds. Like any real estate company, OLP faces environmental regulations and the risk of contamination on their properties. They usually get a Phase I environmental study before buying a property, but there are still risks and costs to be aware of. OLP relies on a relatively small core team, just 10 full-time employees. They also outsource some key services like property management to affiliated companies like Good Investors and Majestic Property Management. Now let's talk about risk, because every company faces them, and it is our job to decode those potential issues. OLP lists a number of factors that could affect their business, such as not being able to re-rent properties or if tenants go bankrupt. A big risk for OLP is its reliance on a few major tenants and a lot of retail tenants. If FedEx or Northern Tool runs into trouble, that could seriously impact OLP's revenue. Also, the traditional retail tenants are facing major pressure from online retailers. It's a tough market out there for brick-and-mortar stores, which reduces the amount of potential tenants out there. Interest rates and access to credit are key things to watch. If interest rates rise or credit markets tighten, OLP could struggle to secure financing, which would limit their ability to grow and manage their debt. OLP's credit facility has a bunch of requirements they have to meet. If they don't maintain their financial ratios, they could end up in default, which would create major challenges and potentially force asset sales. A chunk of OLP's stock is held by affiliated entities like Good Investors. This creates potential conflicts of interest, as these related parties might not always have OLP's best interests at heart. In today's world, you can't ignore cybersecurity, and of course, data breaches are a risk for OLP. They handle sensitive information from tenants and vendors, so a cyber attack could lead to financial losses and reputational damage. The audit committee meets periodically with, among others, our internal auditor and network administrator to review and discuss cybersecurity matters. However, the company acknowledges that those in charge lack significant formal IT or cybersecurity training. That creates further risk. OLP owns 100 properties, including 2 operated by joint ventures, which translates into 10.9 m square feet. Here's a look at their 10 biggest properties. These are spread out across different states and sectors, with a mix of industrial, retail, and furniture tenants. The most important factor to notice is what percentage of contractual rental income each property accounts for and their square footage to understand overall occupancy. Here's the schedule for when their debt is due. A large chunk of their debt matures from 2025 through 2029, making it vital that they can refinance on favorable terms. OLP is managing market risk by hedging interest rates and diversifying its debt maturities. It's all about trying to stay ahead of the curve and avoid getting caught off guard by rising rates or credit market instability. Switching gears to the hard numbers, total revenues slightly decreased year over year. However, we need to break that number down into its component parts. To understand the change in total revenue, it is important to note how revenue has changed at stores that existed both this year and the previous year. The increase was offset by leases that expired at several properties. The company states that real estate expenses increased primarily due to a confluence of higher individual real estate tax expenses at a number of locations. Overall, OLP is navigating a complex landscape with a mix of growth opportunities and significant challenges. So, what does all of this mean? One Liberty Properties is definitely trying to position itself as a solid player in the REIT world with a focus on industrial properties, stable leases, and a nice dividend. But like any company, they face risks such as dependency on a handful of tenants, interest rates and the volatility of those rates, and cybersecurity threats, to name a few. What I find interesting is the recent shift towards industrial properties, likely to capitalize on the e-commerce and supply chain trends. However, they still have a considerable amount of retail properties, which makes them susceptible to the volatility inherent in that sector. The company's executives mention wanting to boost stockholder value. The best way for them to achieve this goal is to have a clear plan in order to tackle debt obligations and manage risk factors. As more leases come up for renewal and as interest rates possibly rise, there's potential pressure on the stock price. OLP seems to be at a crossroads, balancing growth with risk management in an evolving market. Its long-term success will depend on how well they execute their strategy and respond to these market dynamics. Thanks for watching. If you found this breakdown helpful, please hit that like button, leave a comment, and of course, subscribe for more in-depth corporate analyses. See you in the next Decode.